Most traders never look past the major pairs. Your US GBP/USD, US JPY, familiar names, tight spreads, plenty of coverage. But there is a whole other category sitting quietly on your broker's platform that most retail traders either ignore or misunderstand. Exotic currency pairs. And if you're curious about them, there are a few things you need to know before you touch one. An exotic pair takes a major currency, usually the US dollar, the euro, or the British pound, and pairs it with the currency of a smaller or emerging market economy. Think US TRY, that is the dollar against the Turkish lira, or ZAR, the euro against the South African rand, or USDMXN, the dollar against the Mexican peso. These are real tradable markets, but they operate by a different set of rules. The first thing that changes is liquidity. Fewer traders participate in these markets, which means spreads are wider, sometimes significantly wider than what you see on the majors. Getting in and out of a position at the price you want is harder. That cost adds up. The second thing is volatility. Exotic currencies can move sharply and suddenly. A central bank decision in an emerging economy, a shift in government policy, a spike in inflation. Any of these can send a currency moving by several percentage points in a very short window. That kind of movement creates opportunity, yes, but it also means losses can escalate quickly if the market moves against you. Trading exotics with leverage amplifies both sides of that equation. Only trade with money you can afford to lose. What drives exotic pairs is also different. Commodity prices matter a great deal. The South African rand tracks gold and platinum. The Brazilian real moves with soybean and oil exports. Global risk sentiment is another major force. When investors get nervous and move towards safe haven assets, emerging market currencies tend to take the hit, regardless of what is happening locally. You also need to follow local inflation, central bank credibility, and political conditions in the country behind the currency. Some traders are drawn to exotics because of the carry trade, borrowing in a low interest rate currency and holding a high yielding one to earn the difference overnight. It is a legitimate strategy. It also carries real risk, particularly if the higher yielding currency depreciates sharply. If you are new to Forex, build your foundation on the majors first. Learn the mechanics, develop your risk management, get consistent. When you are ready to explore exotics, a demo account is the right starting point. You can practice with a full range of pairs, including exotics, at ZenithFX.com with no real money on the line. The practical takeaway is this. Before trading any exotic pair, research the economy behind it, its commodity links, its central bank, its political stability. Price action alone will not tell you enough. Context is what gives it meaning.